Next panel discussion, and that's quite an interesting topic. It's something which is required in every sector, and that is finance. Finance strategies rethinking the last mile funding. I would like to begin by inviting the moderator for this session. We have with us Mr. Piyush Gupta, the Managing Director, Capital Markets and Investment Services India Colliers. With 2 decades of experience, he's responsible for developing capital market business in India. He's leading the client acquisition, developing institutional relationships with Indian and global funds, banks, NBFCs, AIFs for capital markets business, and he has proven his expertise in real estate investments, asset management and exit strategy, deployment and business development. Let's welcome Mr. Piyush Gupta. Thank you so much for joining us and moderating this session. Moving ahead, we would like to invite our speakers for this discussion in the alphabetical order. We have with us Anuranjan Mohnot, the co-founder and MD with Gruhas and Lumos Alternate Investment Advisors Private Limited. He has been instrumental in setting up and successfully managing multiple real estate funds, including the setup of 300 crore real estate fund for Lalbai Group as the managing director and CEO. He's been part of the Motilal Oswal Real Estate Fund and real estate team of E-City Ventures. A warm welcome to you, sir. Moving ahead, on the panel, we have with us Mr. Amit Bhagat, CEO and MD, ASK Property Investment Advisors Private Limited. Well, he has more than 25 years of experience in mortgage finance and financial services. He co-founded the real estate fund practice of ASK Group and manages and advises on real estate investments. He was the national credit head for the mortgage division of ICICI Bank and also headed ICICI Property Services. We welcome you, sir. Moving ahead on the panel, we have with us Mr. Amit Goenka, the MD and CEO of Nisus Finance. As a part of the advisory board of the funds managed by Nisus Finance, he has spearheaded the group and corporate governance of the fund pools, the NBFC and advisory services of Nisus Finance. He brings over 23 years of top-tier multinational expertise in banking, direct investments, and strategy. Welcome to the panel discussion, sir. Joining them with them, we have Mr. Nilay Patel, Director and Partner, Deep Group of Companies. Nilay Patel founded commercial and residential construction company in 1980 that builds luxury residential structures. Today, Deep Group is well known as a front-runner company in real estate and construction business. And joining them with all the panelists and the moderator, we have Rocky Israni, the Managing Director, Pacifica Companies of India. He has been responsible for the group's growth and expansion since 2006. He has expanded the portfolio across residential, hotel, senior housing, IT parks, townships, commercials, and plotted development across 7 different cities in India. He's constantly striving to explore newer opportunities for innovation and value creation. Thank you so much, everyone, for joining, and the panel and the stage is all yours. Thank you.
Thank you, Realty Plus, for having us here. Good evening, everyone. A very warm welcome to all the panelists. In last couple of sessions, we heard a lot of euphoria about growth, sales, be it on office, residential, retail. I think everything has to also result how we're going to grow this, and which leads to the question, how we're going to finance it. Financing in real estate has always been a very tricky one, and specifically what we have seen in last 3 to 4 years' time, it's been a disruptive phase for financing in real estate. And just to give you some numbers, there were certain players, NBFCs, who were investing a lot in real estate. Maybe they've invested more than 1.5 lakh crore between 2012-13 to 2018-19. Now all of them have vanished from the market. It's not only they're no more investing, they have kind of withdrawing their capital. We have constant changes in regulations, what a bank can do, what NBFCs can do, which is leading to rise to newer structures, newer players in the finance, and the newer modes of financing. So it will be very interesting to hear from our very esteemed panelists today, how do we see the overall real estate financing scenario emerging. So, Amit, we start with you. We have seen a lot of disruptions in last 4 years' time, which continues to. How do you see overall real estate financing, playing out? We have one end banks, now we have NBFCs, AIFs are emerging as a more preferred option. How do you see a landscape of real estate financing?
I think I'll divide this into three parts. Ahmedabad is an exception, and I must congratulate all of you who are based here that I don't see too much of a stress here in this city. But if you look at other cities where people over borrowed for buying in land in the past, and if you look at the behavior of the banks, NBFCs and funds, banks are very strictly focused on giving only working capital or construction finance. And they are very strictly regulated, especially in the last 5 years, after the NBFC crisis or around the NBFC crisis. So they are very strictly focused only on construction finance. NBFCs can be divided in two categories. One category where every non-banking finance company who went overboard, exuberant, aggressive in the past, is managing his own book. So they are giving money to their own projects just to salvage what can come out of the project actually. And the other category, which is well capitalized and who were not aggressive in the past, are lending, but they are very, very cautious in lending. They want less leveraged players, they want margin of safety, they want a receivable cover of 2 to 3 times, all approved projects, preferably mid-mile funding, not early stage. And I think funds are flexible. But if you look at the universe of funds which are available, there are only 4 or 5, as we discussed before this. So I think the capital availability to the sector is the biggest challenge today, especially when sales slow down. And that is why I think it's hats off to the city where you are based, where I don't see too much of a stress. Because either you are well capitalized or you are well backed by investors, informal set of investors. I think that is my understanding of the current, especially the top 5 cities are. So there are people who are listed, they can raise money, and they don't need money from other than banks. People who are unlisted, and they don't have any access to capital to replace their earlier. And imagine, when the NBFC were lending very aggressively in 17 and 16, that money was a 3 to 5 year money. So even after moratorium, that money is becoming due now. And there is no replacement capital available. So one is that the NBFCs restructure them and give them more additional working capital because 20 was a washout year. And that is the only option available with people who have lent very aggressively in the past.
Amit, taking your point, so that leads to the point that we are starved of capital. Maybe cities like Ahmedabad are an exception because of reasons which you also mentioned. Amit, coming to you, how do you see? You think a newer structures, newer players emerging, and is this giving an opportunity to newer set of investors, maybe Indian, global, to tap this space of investing or giving more flexible capital, which banks cannot do?
So I will divide my answer into 2 parts. One, yes, there is short of capital. Second, no, there is enough capital. So both are true actually. So what Amit described as being short of capital is what was available domestically to pretty much everybody. 25 crore, 50 crore, any amount of money to anybody who went and wanted to start a project or was stuck, could take money and do whatever they wanted. So that obviously is not available. That easy money drip which was being fed across the country, and the whole sector was going on an opium drip. I think that has stopped. I think there's a lot more sanity. I think that sort of easy feed has gone away. But if I look at what for example, what we are doing, also our check sizes have actually more than doubled. In the 2019, 40, 50 crores is what we did. I think now we are able to actually do 2x, 3x that amount very easily. So clearly, one is that the demand for capital has become larger because people are able to conceptualize into larger number of larger projects, which because of the velocity at which things are moving and and the scale at which those guys operate, not just the smaller operators doing a larger project, it's just that the larger operators are able to find good opportunities and we're able to find capital, or we're able to give them the capital for that. Second is that the global pool of capital is actually for India has actually more than doubled. So typically 18 to $20 billion of FDI came every year. Large amount of money went into commercial real estate, some to warehousing. Now because of this China situation, or we call ourselves the China +1 situation, which actually we're not, but I mean, let's say we're still a beneficiary of what is not going to China in the global pool of allocation. So where we were getting 4-5%, maybe we're getting 8-9%. So I see $20 billion actually becoming $30-40 billion of inflows into our country. So one of the largest global majors are today writing very, very large checks. Last week, we were closing a very large transaction for ourselves, and the same guy had for another project, a $500 million term sheet. 3.5 million square feet. I mean, that's a combination of both, sort of refi and greenfield and all of that. So I've never seen those kind of deals in a very, very, very long time. And that's just one guy, and he's not even the biggest guy in the city. So I'm just saying that the total amount of capital getting deployed currently is actually very large, largely from global sources, of course. Domestic sources have shrunk a bit, but I think we're supplementing what the global capital is not able to provide. So I think as a sum of the total amount of money in circulation or available for real estate, I think is very significantly large. Also, I think what Amit described as being informal sector, Ahmedabad has been a big beneficiary, and so many others. If you see the way other investment classes have been performing, I think the fallback to alternatives have also grown. All of us have been raising more and more money. All of us have been getting more and more demand. My LPs have come back and said, can you put more capital to work? Because other asset classes don't seem to be sort of having the heady times that they saw last year. So people have actually earned profits. They're not putting back. They're saying, okay, let's put that capital to safe use, or a more defensive strategy, which is what I think alternatives and real estate provide. So, so my answer is there is a lot of capital, but for a deserving few. So yeah, I don't think there's a dearth. And I think those who are not getting it maybe don't deserve it.
No, absolutely, Amit. So recently, we had attended this PERE conference, and, we attend this every year. Until a couple of years back, pre-COVID, it was China, China, China. This year, not a single mention of China. All about India, other Southeast Asian countries. So that clearly reflects that India will become the more and more, central and focal point. And the FDI, which we see, will increase exponentially. But another point, Amit, which you made out was the domestic capital, where the investors and even markets like Ahmedabad, the developers have been managing the balance sheets. Why this? It's we call it informal sector or retail investors who've been, doing this. So Anuranjan, from your experience, you've been also in the market to raise, domestic capital through HNIs or institutions. How are you seeing the demand from the investor side to invest in real estate and give us more flexible capital?
See, these days the investors' appetite is more towards, doing high yield products to real estate developers, and so the risk appetite of investing equity with a developer is hardly anything, And particularly if I talk about a city like Ahmedabad or maybe any city of Gujarat. The issue is that, can we invest equity in Gujarat? The answer is no, because a lot of corporate governance issues, any investor is raising a red flag off. So the key problem with a market like Gujarat or Ahmedabad particularly is that can we deploy larger pool of money here? The answer is no. Issue is that, the practices which we see, particularly on corporate governances, which we find that, the corporate governances across India is much, much better than what we see here. But at the same time, the developers in Ahmedabad are far, far better in managing their own cash flows. And that is the reason why we see that there is hardly any stress project in Gujarat as such. Okay, so we have to give a great marks to all these developers, how they manage their cash flows And to make sure that, in fact, the delivery time in Gujarat particularly is by and large on time. We don't see many cases where the project is delayed beyond 6 months, 9 months, year, like that. So the stress project is not there. Investors across India want to invest in a situation where the last mile funding opportunities which are available, or the opportunities where there is a regulatory arbitrage. Regulatory arbitrage means where banks and NBFCs are not, because of regulation, are willing to invest or are capable to invest. So they see a huge arbitrage there, that there is an opportunity for a AIF to play a major role in funding those projects of last mile funding project or structured finance project or management funding, where the project can be completed in 2 or 3 years. They can make a decent returns. They come after approval. So the approval risk, everything is taken care of. But at the same time, they are also getting a 18 to 20% kind of IRR. And they are not going into a very large, I'll say, a cyclical risk of real estate. So they know that within 2 years, the project can be completed. And within 2 years, by and large, the project can be sold out and they will be able to make a decent returns on that. So they don't want to really go into a very long gestation project at a very early stage project. They want to play safe. And the reason why they want to play safe is that the past experience of investing in real estate funds particularly, or investing in, even the bonds of NBFCs, of any real estate focused NBFC, the experience was really bad. So hardly any real estate fund has performed, except the 2, 3 are there, So investors are very careful. They want to take risk. They want to diversify, particularly in a case where these days the stock market, is likely to not perform for at least next 1 year. And when we are seeing that, the interest rate cycle is going up, particularly in US, the consequences of that will keep flowing to Indian market. And when people are talking recession, global recession, this particular asset class seems relatively safer, I will say, because anything can happen, it can go down by 50% in day one. So real estate as such is looking as a very comfortable asset class. Risk profiling has to be done. Investee companies has to be good, transparent. We always wanted to invest more money in Gujarat, but unfortunately, we're not able to do larger, despite me sitting here in Ahmedabad for 10 years, just because of corporate governances. So things has to improve.
No, definitely real estate has been more resilient, and in these times it's definitely stands out from a safety angle. But just taking some more developers' view, Nilay, how would you all as a developer kind of manage your balance sheet? As we heard that one will take equity for land acquisition or an NBFC money, then take concession funding from a bank, then when the project reaches mid-stage, kind of refinance it by getting some other investor. That's a typical, on a pan-India basis, how any developer would manage his balance sheet. But some developers, better governed developers, or maybe put it, or markets like Ahmedabad has been different, right? What's your view? How differently one can play this?
So how you put it was a traditional way of doing real estate business. Gujarat doesn't do it that traditional way. Developers in Gujarat or Ahmedabad are a little conservative. Before they go off for a project, they at least have about 20% of the funds in their pocket, the land fund. So they put up that money as the down payment. Then the trust factor within Gujarat is so high amongst the developer and the buyer. or developer and the investor. So we talked with Rocky very recently. What developers normally do is they put up 20% of the fund from their pocket, and then the quick fund they need, they get it at the RERA stage, sometimes before RERA, from their close group of investors, the HNIs you say. And they put up like 20% of equity against it. They cut down their margin by 10 to 15%, as you said. And the investor gets a 20%, 25% of a chunk at the stage of the building use permission is received. So the 10, 15% of a down payment, and then 10% of a price hike by the completion of the project. So those kind of investor groups, every developer has their own their investor group. That's when they get their working capital. We do get land parcels at a decent installments. 1 year, 1.5 year, 2 years. So that also plays a role. So and also there is a trust between the land seller and the developer. So you get the approvals even before the land payment is complete. So you can start your project before the land payment is complete. Lot of fund gets collected from the investors and the buyers, I mean the end users as well. So then the things, once the ball is rolling, I think the things get pretty smooth.
So I think a couple of interesting points, Nilay. One is how you structure your acquisitions, right? Maybe a staggered payment. Number two, getting in equity, whether it's your own equity or equity from friends and family, where there's a comfort level, right? Now, does this give enough margin of safety if things were to go wrong? So, Rocky, what's your view? You think it's a safe way of doing business and it can sustain any kind of downturns?
So, the way we said this, Ahmedabad market behaves very differently than the rest of the country. We heard the fund side saying that we don't have corporate governance. So that's where they're talking about. Can everybody hear me? No. Hello? Yeah. So this is exactly what the funds are, the capital is talking about, that we don't have enough corporate governance. So what happens is the Ahmedabad market works in a very, still the old fashioned and the traditional way. RERA has come, but you know, our financial structure has still stayed the same. Obviously, we cannot collect a single rupee until the RERA is there. But our structure still continues here, that you are pre-RERA, pre-launch, and pre-everything. So that's what they're talking about corporate governance. I constantly, tell if Ahmedabad needs to mature, we need to raise our bar of corporate governance, stop violating things like, the approval process and, even the cash component to an extent. Because, obviously that itself is a deterrent for any fund to invest. But the current structure, because the leverage is so low, it's working fine. In a typical, other than Ahmedabad cities, your leverage level is high. You not only have a land acquisition level leverage, which is equity, then you have a private equity, which is debt, quasi-equity or a mezz, whatever you can call it. And then you have a construction finance, which is a conventional bank debt. So creating 2-3 levels of leverage, which a typical developer in other cities has, which an Ahmedabad developer does not have. So that kind of has a check and balance mechanism, which doesn't let the project financials break apart.
So, you are present in many cities, that's why I think you have the ability to say that, Rocky.
Yeah.
And I have to compliment you for that, because very few people in Ahmedabad will recognize what you just said. So thank you for that.
No, you're welcome.
I wanted to ask you as a developer, when we go and see products in Bangalore, Chennai, NCR, the quality in this city is still below the average of what we find in cities like Bangalore and Chennai and NCR.
So quality is a function of what a consumer is able to pay, right? So it's not like an Ahmedabad developer is not able to do a quality work, right? If you see in a more affluent areas of Ahmedabad where the pricing has gone up, not necessarily the percentage margins, but the pricing has gone up. To justify that, the product has also, developers have added a lot of bells and whistles, amenities, become more quality conscious, have hired PMCs. So we're seeing that quality bar raise up in the last maybe 5-7 years. We're not up to the mark as Bangalore yet, but 70% of the city's sales are coming from a mid-market, your mid-price, not exactly affordable home, but mid-priced homes, where the consumer is not willing to yet pay that price for the quality. So the quality is below par. The Bangalore customer has progressed. He's not willing to accept anything below the threshold mark. Versus an Ahmedabad customer, a mid-market customer is okay to accept that. So hence that quality differential that you see between Ahmedabad and other cities.
And I think you rightly mentioned on the governance side also, where I see that the efficiency of the saleable to carpet, although the registration is on carpet, that information in the sales brochure of developers is a complete black box in this city. So, the challenge as a buyer, I've also gone as a buyer, and I have seen that although they will give you the price, ultimately the registration has to happen on carpet, but this is a missing link completely, and rightly mentioned by you.
So this is a puzzle that the builders don't want it to be solved. It's not like it's very easy for me to put a carpet out there, but this is a puzzle that still builders across the country, it's not just Ahmedabad. Most of the cities are still selling super built. Maharashtra has one state which has progressed to saying carpet, right from pricing, right from the documentation, and even in their messages or their collateral. But other cities I see, even metros, Chennai, Hyderabad, Ahmedabad, Bangalore, they're still advertising pricing as super, but doing documentation as carpet. So some transparency has come. We're hoping that the RERA carpet will get implemented sooner than later in all cities.
So, is the overall financial structure which we talk about, and especially we talk about Ahmedabad, which what we discuss is more coming from informal sector, friends, family who's putting in as equity. Maybe investors refrain or maybe are more skeptical because of these reasons. These are all part of the governance matrix, right? So, I don't know, how would the investors, Anuranjan, you want to make a point?
I was just, Amit mentioned that almost around $20 billion or $30 billion is coming or expected to come every year to Indian real estate. And if we see how much money, foreign money is coming to Ahmedabad or say Surat, and which are the largest cities of India, it's among top 10 cities of country, is almost zero. Somewhere we need to reflect that, a city like Ahmedabad or Surat is not able to compete even with a city like Pune or Hyderabad, which were far, far behind Ahmedabad around 15, 20 years back. So that's the just one problem, corporate governance. And that is where, if it continues, probably next 15 years also we'll be discussing same thing, that the inflow, capital inflow in country will come to say 40, 50, 60 billion dollars. How much Ahmedabad is getting? Probably zero. So, and foreign capital, why we need it, is a patient capital, it's a long-term capital, and this all helps in scaling up the real estate business of the city, and we are seeing across India that how the cities have transformed itself. Let's say Bangalore, from a population itself will be like 2x or 2.5x in just last 15 years or so. So this kind of transformation can happen only if, a lot of patient capital is coming, a lot of foreign money is coming, and investors have confidence while investing with you. Otherwise, we can keep on growing in a natural way, but if we have to compete with other cities, then probably we are far, far, far behind.
So, yeah.
So investors, are we have to segregate them. Most of the institutional capital is chasing the yield assets, which Ahmedabad doesn't fit into that category. When I say yielding assets, it's income generating assets. They eventually become REIT or they go IPO. So that's their exit. So you need a larger patience for that, maybe 5 to 10 year capital, versus the other institutional capital which funds developers. We're talking about developer funding. Has a shorter duration, maybe 2 to 4 years. So the cycle needs to be exactly 3 years for it to be funded. So obviously the project cycle from land acquisition to completion is not 3 years, it's a lot more than 3 years. Acquisition, then entitlements, then sanctions, approvals, RERA, and then sales and construction. So it's about 5 years. So residential capital for developers is different than all the foreign capital that comes in. All the foreign capital which comes in, 90% of that has gone into income generating assets. So only dry powder left with funds, meaning with Amit, with Anuranjan, is for that last mile funding or project funding, which project doesn't qualify for a CF, construction finance, is very little. That scale is very small. The billions that we are talking about is not there, you know. So it's a very small amount of capital.
So I think one of the things that Ahmedabad has, I think, is growing infrastructure. I think when you walk into the city, when you land into the city, I mean, it's a great city to be in. And it's an amazing city to be in. I think it's just about how does the Gujarat real estate sector transform itself to become more global. And I think one of the examples of global capital is, let's say, even a Phoenix Mall coming in. I mean, that's finally backed by global capital. So it is global capital directly or indirectly coming in. There are warehouses coming in. That's also global capital, which is directly, indirectly coming in, which is all developmental assets. So you've got ports, you've got airports, you've got railheads, you've got a lot of things going on. I think it's just about mindset. Can Gujarat transform as a real estate sector to becoming a global enterprise, becoming a larger institutional enterprise? I think the answer is yes. It is about the players wanting to do it. I don't think there's a dearth of money. I mean, how much capital can go into 4 or 5 or 6 cities? You know, clearly, I think if you look at the top 2 or 3 cities of wealth creation, it is in Gujarat. I mean, so if there is so much wealth creation in the state, clearly the demand for global products, global assets, can we not go and do an SEZ? I think now the SEZ policies become so accommodative. You can have domestic, international, export-oriented, everything under the same house, and hopefully that'll become a law. I'm just saying that there is an opportunity here. It is just about how we conduct our business. Are we looking at short-term gains or long-term gains? I mean, you know, there's been a huge opportunity for every player in Surat, Baroda, Gujarat, in anywhere in Gujarat and Ahmedabad to make short-term gains. Build a small, 1 lakh, 2 lakh, 3 lakh square feet, 4 lakh square feet development, monetize it, move on. You know, can you do longer-term development? So I do believe, so you're right, you know, there is bulk of the money, institutional global capital will go into, you know, core assets, core plus assets, long-term developments, but there is enough and more money for townships as well. You know, we've seen huge townships come up near, you know, the new airport of Panvel, which is not even operational. You know, global capital is going into even developing those townships. Right. They've done well. It's futuristic, but it's done well. We've seen that in Bangalore, you know. We've seen that in Pune where the airport has not come. We've seen that now in Noida where the airport has not come. So there is global capital wanting to go into development sector. It's just that I request the players to start thinking, can I draw $100 million of global capital and actually create an infrastructure, a township, you know, multi-integrated development which will actually serve the city and the state for the next, you know, 3-4 decades. And if you want to do it, I think there is enough. You know, corporatization, we have now enough more corporate players getting out. We're just discussing a few names, you know, and Rocky's here. And I think it's amazing that Rocky here because that corporate mindset that is there, that I can actually go out and build a complete, transparent, you know, auditable balance sheet and actually do an institutional product. You know, that's something we really look forward to. All of us here are very keen to invest in the state. We just need a partner that we can work with for a longer period of time, that can be very transparent about their dealings, you know, can be very upfront about what they can and can't do, you know, and it's not short term, you know, so that's, you know, so to answer Piyush, I don't think there's a dearth of capital. We just need to find the right partners who can walk that mile. You know, you mentioned a few corporate names who are already getting that capital. Yeah.
And also, Amit, you know, if at all we look at Bangalore as an example, 15 years back, we got some of the developers in Bangalore doing large integrated townships, business parks, which got some global best tenants, right? Like the Microsofts, Apples, Amazons, which kind of, you know, takes your overall level of quality governance to the next level. And after in last 7-8 years, you have seen whatever happened in Bangalore on the residential side and the governance side. Maybe doing some, good office, developments, some partnerships could take this to the next level. Amit, what's your view?
I think Gift City will definitely provide that impetus, and I can see it happening, although it is at a much lesser than the desired space. But I think Gift City will give excellent income yielding assets. It's a matter of time, whether it will take 3 years or 5 years, I can't say right now, but it is very promising. Unless and until knowledge economy jobs, which is IT jobs, I think all other cities are driven by IT. Manufacturing does not produce your income yielding jobs other than logistics, which has now come in. I think IT is a missing link. So I don't see that IT SEZs coming here. But because of the global financial center, international financial center, I think that will be filling that void. Coming to the residential side, if you look at the data of 21, total $6.2 billion of FDI came in, out of which 1.2 billion was residential, and 5 billion was all data centers, logistics, and IT. 1.2 was also debt capital, no equity, zero. $1.2 billion of debt capital for a country where all the banks and mortgage companies and NBFCs have a total of $80 billion of debt, out of which at least $20 billion has to be replaced. I think that is the paucity of capital.
And we didn't get any out of that 1.2 billion in Ahmedabad.
So, but if I look at all other cities, investors have vanished everywhere. Whether it is NCR or Pune, Mumbai, Bangalore, they were never there, and Chennai also. This is the only city along with Hyderabad where a developer is buying land and investors, because you have too many HNIs and PIOs and NRIs, they are willing to support you. And when they support you, they eventually are investors. So while you are selling, they are also partly selling, or you are selling on their behalf. And I think that is why, and the re-rating of the prices have happened in the last 3, 4, 5 years, because it has become a excellent infrastructure. With all this airport, Gift City, and many more your ring roads, and now proposed bullet train, I think it's just a matter of time. And as governance improves, all of us will be here for investing, is what I feel.
And I mean, just a follow on to you, if you were investor's hat, would you put money as equity in residential?
If there is governance and it's all check in the land and in the transaction, I will definitely bet on this city for residential.
I see Amit smiling.
No, sir. I'm never a fan of equity investments. I think it needs a lot of, a lot of steel in the right places to put equity, which Amit has. Maybe I don't. I just think that. See, I think equity. Equity is a multiples business. It's not an IRR business. And I don't think real estate can provide multiples in residential. And if it can't, then I would rather stick with credit or structured, because then I'm playing for IRR, I'm not playing for multiples. And even if you invest it for 10 years, I don't think you're going to get multiples in real estate. So to me, that becomes a limitation. I would love to do equity if I can generate multiples on capital, because I'm not taking anything out in the interim. I would love to put in 100 and get back 300, 400, 500x or $500 at the end of 5 years, 7 years, 8 years, whatever. And I'll be very happy with that. But the probability of that happening is actually next to zero in my view. And if it doesn't happen, and then rightfully so, because it is not a speculative asset class. It's not going to become 300% in value or volume in 5 years for the same project. I mean, I've heard FSI actually tremendously increase in Ahmedabad this morning, and I was actually quite surprised. And maybe people would have made a multiple out of real estate in Ahmedabad as well. I don't know. I mean, with so much of land prices going up and so much of FSI going up, maybe people would have ended up making a multiple. But it's unforeseeable. I mean, I can't predict that suddenly land prices will become 3x or 5x in 3 years, or FSI will become 2.5x, in 2 years. So it's unpredictable.
So I don't see. I don't see anyone anywhere in the world putting money in equity for residential. I mean, it's not viable.
Unless it's sustainable, where your yields are
Exactly,
commensurate to
exactly.
the.
So the reason behind especially for Ahmedabad or any city in Gujarat, most of the bigger cities in Gujarat can be scaled outside. I mean, we can grow anywhere in any direction. We have space. So as things start growing expensive within the city, people start moving outside. So it's not like Mumbai. So Mumbai, you can probably put, I don't know, I won't comment anything about the current scenario, but for a city like Mumbai, you can probably put some money in equity because there is no space to grow. So, but in Ahmedabad or any city in Gujarat, nobody will put any money in equity. People will definitely put it in debt. Gujarat is a very safe place to invest. We have not seen any project in Gujarat getting delayed by more than a couple of months. So any investor, organized investor can come and put in money in that and easily get their money back.
Now, if I put it if you are the developer, get equity money, will you take it or you will still want to take debt?
Depends at what stage. So if it's
Early stage, assuming early stage for
if it's
acquisition.
an early stage, I will put it in equity. I mean, I will like
You
the
will
person to get, like to get money in equity.
Just one thing I'll add. Equity, you don't invest when your Sensex is around 20,000. You know, the Nifty. Equity you do in cycles. So when you're, when it's a cyclical downturn, equity is done. We did equity from 2010 to 2016, 17. In 17, we said now there's no point doing debt because you can get equity-like returns with a debt-like structure. Now, when the governance is there, backed with scale, and brands are there, both in buying of land as well as in selling the ultimate apartments, equity is there. If you go to top 7 cities of US also, you will see that there are 15 home builders there. They control 75% of the multi-storied apartments supply, 75% in the top 7 cities. But there are billions of dollars of companies, well capitalized, listed, most of them, they get equity. So equity is available today also. We have done it as late as 17 and 18, we have done equity in Chennai with reputed corporate brands. It's a question, but it's a corporate. I think that is the difference.
Yeah.
So, this equity is different than the listed entity equity that we are talking about. This equity is expensive for developers, makes a developer little more complacent. So in Indian scenario, most of the equity deals had gone bad from 2005 to 8, 9. And structured debt is what is replacing the conventional debt. Developers who cannot get, or the projects that don't qualify for the conventional lending, which is from the banks or NBFCs, they go to the funds. Now, fund can invest this, call it as equity, quasi-equity, debt, it's all the same product. If they take higher risk, they want higher return. If they take lower risk, they want lower return. So the band is from 14 to 22. So the debt can start at 14 and, structured debt can be at 17, 18, and then equity, they expect 20+% return, which is not possible in today's scenario. Developers don't make that kind of money. So it is advisable for both the developers or for the funds to go with a structured debt structure today, the way the environment is today. And especially, we're talking about Ahmedabad, I don't think so. There is the market has matured to take equity from the institutional capital. Market is not matured enough. There is cash element, there is corporate governance issues, or so on and so forth. People are sitting at the historical land cost. They need last mile funding. I think the structured debt is a better product for developers to go for.
Anuranjan, you had a point, yeah.
See, what I've seen is that post-RERA and post this NBFCs and all, after a lot of default from developer side, a lot of developers in jail and all, the demand side, a lot of developers are now preferring equity, even if it is a little bit expensive compared to the debt one, if it performs. Okay. So there is a huge demand. But the problem is on the other side. The investors who want to put money, they are averse because of the past conduct of the same community of performance. So the demand is there, but supply is not there. Supply of equity is not there. Whether equity is advisable, yes, of course it is advisable. How long, your debt equity ratios can be 6x, 7x, 10x, and then we say that, the developer is not performing. Somewhere, if you are in a growth phase, growth will need equity. And without you, balance out your balance sheet, the growth will not be possible in any sector. So the thing is that who can take equity risk? I believe that, in India, given the judicial system what we have, a debt is almost at par at the equity risk. If I have to enforce my securities through process of law, then I've taken an equity risk. So the thing is that equity, if the environment from the developer's perspective, from the developer's side, or from the regulator's side, if it is right, then yes, plenty of equity should be available. And people will have confidence on putting equity with the developers.
Just to add to point why equity is required, the under construction inventory across the country, which used to be between 24 to 48 months for each city, has come down. It's just because there's no capital available. So if there is no growth capital, debt will not match it. So we need equity, but we have to be ready for equity. When will we be ready for equity? Maybe 2 years or 3 years along. If there is so much of liquidity on the debt side, that there are no deployment opportunities at high cost as Amit and all of us want, then we'll have no option but to go to equity.
No, but I agree with you, Amit, but I also concur with Rocky, because what he's saying is really equity or credit or debt or structure is effectively all the same. You and I both, in my mind, are actually doing quasi-equity because we're taking a certain hurdle, we're taking a certain catch-up, we're taking a certain pref return, which is nothing but what an equity guy would want.
No, I am referring to the equity which I have done 20 transactions, which is pure pari passu.
Pure equity, pari passu is gone.
Pari passu
Done.
before
gone.
approval for buying land. And unless and until that comes in, your under construction inventory, which is declining, will become a cause of, so it is very good for developers currently who are sitting on land bank that yes, the prices will go up. But at the end of the day, we also need affordability. Please understand two things. The cost of taking a home loan today is 7.5% to 8%. The rental yield is 2%. This only happens in India. Second is that when you buy a under construction property, you pay 5% GST and 6% stamp duty. So you are negative NAV 11% day one. Why an investor will buy a house? No investor should ever buy a house. Only a user should buy. And if a user does some mathematics and he's not emotionally attached like all of us are while buying a house, he should stay on rent. And I'm not saying that because I am staying on rent, but...
No, that I think precisely the reason why equity in residential is always difficult to work, because you have a 6% negative delta between the cost and what you yield. So it will never, and equity globally also is coming in assets which are yielding sustainable. Residential will not be sustainable from that perspective.
No, rest of the world, you have positive yield on...
Exactly.
on
Only in those markets like US or
Yeah.
even in Europe, a lot of the markets are having a positive yield. from
Most
that
of the
perspective.
markets you
Yes.
will find it, except, as I said, it only happens in India. Yeah.
No, another point is foreign investors are not allowed to invest in India. London, Dubai, Singapore, New York, everywhere it thrives on foreign investors. We are the only market which is pure based on Indian users, negative NAV 11%, plus if you buy a second home, there is no tax benefit. So you are, this is the only country.
That is why we are also not getting residential REITs also. That will also come once either the pricing goes down or the yield goes up or the cost of capital goes down. One of the three has to happen. Yeah.
And the REIT regulations must allow housing as well. Today they prohibit housing.
Oh, they prohibit housing? I didn't know that. I thought the REIT is a REIT. Okay.
Which is what he said. They don't like foreigners coming into the housing market.
Yeah.
In any form and shape.
Yeah.
And then another point, we speak a lot about last mile funding, and see, last mile funding is a concept we're discussing for the last 2-3 years time. because projects are stuck, stressed, and hence, to give the last mile completion, execution capital, we have this opportunity of high yield. Now, is this opportunity here to stay? Or, whatever we have seen in last 2-3 years time, people have invested, taken those high yields, given execution capital for last mile, or this is a story over, or there is more to follow, and in which parts of India? I'm sure it's not in Ahmedabad, or maybe not any part of Gujarat.
I think that opportunity exists for another 2 years, maybe 3, purely because unless and until that NBFC debt where either a haircut is required or after restructuring that payment is becoming due, whether it is $20 billion or $30 billion, it's a debatable point. But, and some of the problem is being solved by the NBFCs in their own portfolio companies. This opportunity will exist, but it is not a very sustainable opportunity which can be done for a decade. So I feel that because this is not, when you on the one side you are saying the margins are not 20% plus, and that is why equity is not going to come in, then I think there is no way that you can sustain this high cost money at 20% or 18% or 21%. So it is not sustainable. It is just that the legacy issues are being resolved. And once that is resolved, I think, and liquidity comes back to the sector, cycles are always becoming shorter now. I think we'll be back to low yields and equity.
Anuranjan,
Yeah, you're right. The opportunity of last mile funding or various structured product, probably next 2-3 years, that's max. A very limited opportunity and one time. And that happened because of multiple crises, what we have seen in real estate from last 5-6 years. So these incidences doesn't occur, again and again. So right from demonetization, RERA, GST, NBFC crisis, or then election, COVID, one after another event for good 5-6 years, that created all those opportunities. And these doesn't come again and again. So of course, the opportunity is limited. Opportunity is only for next 2-3 years, max. And then we'll have a similar cycle with more prudent developers who are willing to balance their balance sheet, with proper equity, proper debt. They understand the debt equity ratios, not over leveraging, ready to sell to make sure that the project is de-risked from the marketing perspective also. And the best part about Ahmedabad is that, yes, we have seen that the maximum pre-sales they do to make sure that the construction cost is taken care of. That is where, this is the USP of cash management here. And buildings are not, genuinely late, and the approvals come on time, We don't have problems here of 6 months, 9 months, a year kind of delays in approval, even the tactics of getting some more benefit for giving approvals. Generally, it's not there. So that is where the project cycle gets within the time limit what they envisage.
So the industry is very well regulated now. So all these legacy projects which were coming from the unregulated era to the regulated era, which is like pre-RERA or post-RERA, right? So most of the projects now have a check and balance or a fund control mechanism from RERA itself, making it as I said, the funds need to be controlled and utilized in the project itself. So the opportunity to do a last mile funding will exhaust eventually, unless there is some misappropriation of funds, by fraud or by something. But then the regulator itself will take over those projects. So regulator will intervene and do something about those projects. They won't go to private equity or institutional capital to raise last mile funding. This is what I think.
And just one question, I think so we kind of all agree that residential growth could be funded by debt, right? And so far what we have seen is more domestic debt coming in. Do you think it's a, I think, great opportunity for global investors, maybe who've been doing office and other yielding assets, to form their own credit platforms through current managers or their own management, to invest? There's opportunity that goes in billions, because all this residential growth across India requires capital. If it's not equity, it's debt. So is that a, I think, big opportunity knocking at the door for some of the, or maybe quite a few large investors?
Unless there is a yield in that asset class, which is residential, the foreign investors will not be...
You do credit, like, doing debt, what Amit are doing, foreign capital give monies to them or from their own platform to give debt at 16, 17%.
So that's exactly what funds do. They collect money from the HNIs or, high net worth individuals and investors, and they manage the money for them. But them taking over and building a platform is not a viable solution. They could syndicate capital and invest in, like a lot of platforms have come in who are doing, strata sale of income generating assets like Strata, or 10 others have come up. Or then there is a yield which is in a managed residences like hostels or student living or co-living. Then there is a yield automatically from that 2-3% goes to 8-10%. So they won't mind lending money or investing with a co-living platform, where the co-living platform actually owns the residential assets, where the yield is much higher. So being a passive investor without having a stable platform, it would not happen in India anytime soon.
Okay. Amit?
I think some people do not, majority of the foreign players do not want to take a development risk. But having said that, credit funds is a very common phenomena. When they come here, if they want a scalable opportunity, they have to compete with banks and housing finance companies, which is what they don't want to do. So they can bring in some flexible capital. And there is a requirement of flexible capital, and that flexible capital is there, and I can see two players, the players who are there with $1 billion and fund, but that opportunity is not very scalable actually, because when this opportunity is gone in 2 years, what will they do? And then they have to compete with banks. Their cost of fund is much lesser, and they are carrying a foreign exchange currency risk. I think that is where...
Sure. I have actually a lot of points to discuss, but I think so we are running out of time. But we can maybe throw up the forum for questions and answers from the audience, please. Any questions? Anyone? Okay, I have last question. Would the borrowing cost for developers come down? We have seen interest rate cycles going from up to down, again on an upscale, but for developers overall, not for Ahmedabad or Gujarat specifically, has kind of always gone northwards.
See, when sales were very robust in 2021, we saw there was interest of lending very clearly visible amongst the lenders. If sales pick up, so it's a herd mentality. When sales pick up, everyone wants to be in that business. When sales are slow, actually that is the best time for a lender to lend at a high cost, but everyone shies away. So it's a chicken and egg story. I think borrowing costs will definitely come down.
See, the cost also factors the performance, the industry performance. The problem is that the industry so far has disappointed lenders, disappointed real estate funds, has disappointed almost all the stakeholders, whether it's customers, everybody, So the funding cost can certainly go down, provided, a lot of things need to be done in this. So,
Last word.
Good guys are getting at good price. People
yes,
are getting at
from the
99%
banks,
also.
yes, banks have already implemented a rating system. A good borrower is getting a good interest rates. But fund houses or the institutional capital is still not able to do that because their own cost of capital is so high. They're competing with the stock market from that same investor. If they get 15% return, which is the cost of capital to the developer, The 25% is income tax, 200 basis point is the fund management and their platform fees. I think the investors or a family office will end up getting 10, 11%, which to invest in a real estate sector, taking a high risk, that is if they don't have any deal going bad.
Yeah.
That is if the entire fund performs the way they have envisaged.
When one deal goes bad.
So one deal goes bad, you're down to single digit. So, you're talking 10, 11% return to an investor in the hands of investor is not very high when he's taking that kind of risk. So we need to understand who are we talking about as cost of capital. We're talking about banks. Yeah, banks are taking fixed deposit at 5%. But that's not the case where funds are getting their money from. And they can't leverage either. They have HFCs and banks and NBFCs can leverage their books multiple times, 3 to 10, 20 times. Fund cannot leverage its books. It's all equity that is deploying as debt. So we have to understand that it's a very difficult situation to bring the cost of capital down.
Rocky is the best spokesman for the fund industry.
I'm sorry?
He is the best spokesman for the fund industry.
I think we are up for the time, right? Yeah, I think thanks all the panelists, thanks for audience. I think it was a very enriching discussion and very open. Thank you all.